This is probably my favorite of the 4 weeks that we've talked about with what people should know selling real estate in regards to the mortgage world. And you certainly not expected to know everything, just like we're not expected to know everything in the real estate agent world, but it's certainly helpful that we know what enough to navigate and have conversations with our clients when it comes to real estate. Same thing for you guys too. Knowing enough in our world maybe will help you save a deal that may have gone sideways. So I will tell you, not every time a lender says no, is it really a no? It could be something that just the lender that the client is talking to may not have a product available to move something forward. And that's what we're going to go through today. So I'm super excited about today's class. We're going to break it up a little bit and do some teamwork between Dixie and Corey, sharing some different loan programs that are out there that are not cookie cutter, conventional FHA, USDA, VA type loans. Some unusual things that a lot of people just don't know exist. But if you have missed the first 3 weeks, this is the final week of the series. The first 3 weeks, we covered what lenders look at in regards to credit. We talked about, I think, in week two, about assets. In week three, we talked about income. I may have week two and week three mixed up, but anyhow, assets, income, and credit, we have covered the last 3 weeks and given you some ideas of what lenders really look at in regards to all those things. And I think it's important for you to know the basics, which is what we've given you. So if you miss those, it's all on YouTube. So we've recorded everything. It's all on YouTube. So you can go back and look at those if you'd like to. And all you need to do is search Legacy Team of Integrity Home Mortgage on YouTube, subscribe to our channel, and follow us. But all of it's there in a playlist under Real Estate Sales Bootcamp. All right. So if you missed anything, please go back and take a look. But today we're going to get started on some unusual loan programs. So, number one is something that a lot of people just don't know exists. Now, back when we talked about income a couple of weeks ago, I mentioned to you self-employed borrowers, which a lot of you are. Most realtors are self-employed borrowers, and when you do your taxes, you may do something called a Schedule C, and you may have an accountant do your taxes for you. A lot of self-employed people do. An accountant's job when they're doing your taxes is to what? Limit what you pay the IRS. All right. And if you have a good accountant, they may be really, really good, and you don't want to pay the more taxes than what you should be paying for sure. So if you can save on that, that's great. But a lot of times, what comes back to haunt self-employed borrowers is their accountant is so good that you're not showing that you make a whole lot of income on paper. Okay. And this happens a lot of times. So, is there something for people that are writing off and having a lot of things written off by their CPA? Very well, may be a case, and that's where this loan program comes in play. It's called a bank statement loan. All right. And what it is, it allows the lender to ask the borrower if there's not enough income on the Schedule C or on the business return. The lender can ask the borrower for the last 12 to 24 months of bank statements, and we take all the deposits going into the account, average it out over that time period, and that's the income that we're now giving the borrower. All right, so it's called a bank statement loan. So why don't we just do this for every self-employed borrower? Number one, the rate is a little bit higher because it's a higher risk loan. All right. It's out of the box. It's not a conventional loan. It's not tied to Fannie Mae or Freddie Mac. So the rate is a little bit higher. Also, it requires typically at least a 10 to 20% down payment, depending on how many months we're looking at and also what the credit score is. But if a borrower can provide 24 months of bank statements, usually the rate's a little bit better, but 12 months we can typically work with. Okay. But this is a big loan program that helps a lot of people still be able to purchase homes, that may have an income problem on paper. All right. So keep in mind what's called the bank statement loan. We definitely do these. Um, Again, the biggest negative with it is it's going to be a little bit higher rate. All right. But I will tell you, we did one of these for a gentleman earlier this year. And again, the rate is about 1 to 1.5% higher than the traditional rate. But he's working right now with his CPA so that we can refinance this and maybe have his next tax return show enough so we can get out of this loan. All right. It may not be a long-term solution, but when you have somebody that's fallen in love with a home, this is a great solution. All right. So that's the bank statement loan. Let's talk about bridge loans for a little bit. Now, we know the market right now obviously has shifted a little bit, but if you're working with a buyer that's got a contingency on having to sell a home, you know already that lowers the chances and the odds a little bit of your buyer winning the offer, especially if there's multiple offers on a home. So, are there opportunities that you can take something that might be a contingent offer and make it a non-contingent offer? Absolutely. We've got two different ways that may be great options for people to turn contingent into non-contingent. So one of those options is through a company that we partner with called Calque. It's Calque. And before I forget to do it, I'm actually going to drop in the chat section a link to their website because this may be something that you want to click on at some point, maybe not right now, but just save it because it's very well something you might want to click on and come back to get some more information on it, or you can share it with a borrower. Okay. That will give them some more information on it. But Calc, here's how this program works. The company Calc provides a guaranteed backup offer on your buyer's current home. All right, so that guarantee allows us as the lender to structure the new purchase loan without a sell contingency. Your buyer moves on a timeline that works for them and not one that's dictated by whether their current home has sold yet. So you can get more information on it by going to their link. The cons of using this are it adds a little bit of a layer of closing cost. However, it gives them a way to bridge the equity they have in their current home to buying their new home. And because there's a guaranteed offer from Calc to buy their home, then because there's that, we don't have to count their current mortgage and their debt to income ratio. It helps them in qualifying quite a bit. All right. So here's the other little piece of that I want to mention to you. And I've got clients right now moving from Arizona to Virginia that are looking at this as an option. It does not replace this backup offer from Calc does not replace their home coming off the market. Their home will still stay on the market and it will still be listed and marketed by their current listing agent in Arizona. So nobody's getting kicked to the curb, but Calc is offering a backup offer just in case their home does not sell in a certain period of time. That's the beauty part. Okay, so that allows us as a lender, again, to go ahead and proceed in getting them approved without having that current home held against them. All right. And Corey just added in the chat, they've got 6 months to get the home sold. It's a long time, right? Most homes, if they're priced right, will sell in 6 months. So we have used this for a number of clients. Um, I don't think, I don't remember any client that's actually had their home ended up being bought by Calc. It always gets sold. But just having that backup offer by Calc, again, that's the beauty part that enables us to be able to get them approved on the new home, not having to count their current mortgage against them. Great loan program. Okay. So here's a little bit of a simpler way to do this too. That's Calc, but another option that a lot of times a buyer can do to make their offer non-contingent is we can do home equity lines on a home that is currently on the market. So we can do an equity line on their home that is listed for sale. Go ahead and pull the equity out of it and apply it toward the new as a part of the down payment on the new home. Now, that's the simplest. It's a whole lot simpler and cheaper to do that versus Calc. Here's the sometimes problem with that. The only way this works, because there's no offer on that home, we still have to count their current mortgage payment against them. I have to count the home equity line payment against them and the new mortgage payment all in their debt to income ratio. Now, a lot of people still can qualify for it and doing all of those pieces, but having to qualify for their current mortgage, home equity line, and their new mortgage, that eliminates a lot of people from being able to use that option. Okay. But again, like my people from Arizona, moving from Arizona to Virginia, I looked at this option first to see if it would work because it would save them a little bit of money, but their debt to income ratio was too high. All right, so we flipped back to Calc. But anyhow, that's another option. All right. Now I want to give you one more option that a lot of people just are not aware that it even exists. Calc, out of the three, Calc's usually the little bit of the most difficult because you're involving a third party company, but we do them. Equity lines, simpler. This is the simplest. All right. If people have enough money for a down payment, let's just say on a conventional loan, minimum down payment's 5%. They have a home that is currently for sale, but they do have some assets in the bank. If they can use their assets before selling their home, use some assets they already have, and a lot of times they can pull money from a checking, savings, or retirement funds temporarily and then pay the retirement funds back when their home sells. But if they are able to get their hands on some money that they already have access to do a minimum down payment, they can go ahead and buy a home and then they use this tool called recasting. Now, a lot of people are not familiar with the term recast, but what it is, when the buyer's home sells eventually, they take the proceeds from that sale and then apply it toward the new mortgage that we did. And recasting will allow the payment to be re-amortized based on what the new balance is. All right. This helps them end up with a payment closer in line to what they were wanting or expecting. To do a recast, there is a fee for it. It's like $250. So much cheaper than refinancing. So what a recast is not, it's not a refinance. The rate stays the same, but the monthly payment does get reamortized based on what the new balance is. All right. So we have had a lot of people qualified for this option to go ahead and purchase, use some money they can get their hands on that are liquid they already have, do a 5% down payment, sell their home, come back, recast. Now they end up with a payment closer in line to what they wanted. Makes sense? Like this is just, it's a great, great, great option. We had more people go that route than the other two, but the other two, especially the calc option, is a great option for people that just can't afford to carry two payments at the same time. All right. But recasting is there. So, next loan we're going to talk about, I'm going to invite Corey to unmute himself, and we're going to talk about something called DSCR. And he'll tell you what that stands for too. Take it, Corey.
All right, cool. Thanks, Jonathan. So, yeah, we're going to talk about DSCR and actually one other product that perhaps has been something that can save a buyer being told no, depending on their specific circumstance. And starting off with DSCR, this is likely not a product that you're going to use on every file, but with the right buyer, it could be the difference between a dead deal and a closed one. So maybe this is not your bread and butter today. Tuck it away. Stay in contact with us, obviously, if you have a situation that might warrant it. All right, so DSCR, debt service coverage ratio. Sounds really complicated. I wish they would name it something different like investor special or something like that, but it's not very complicated actually. Here's the problem that it solves. Most of the conventional loans, which again is not the focus of this conversation, will qualify a buyer or an investor based on their personal income. and their debt to income ratio. If you've got a buyer, however, that owns, say, 5 or 6 rental properties already, their personal debt to income ratio more than likely is going to look rough on paper, even though the properties themselves potentially are even cash flowing. You look at depreciation, you look at write offs, all of this will make a profitable investor look unqualified, air quotes, on a typical or normal loan. DSCR is going to flip this equation completely. And instead of asking, what does this person make? It's going to ask if the property can pay for itself. I'll say that again. Instead of asking, what does this person make? It's going to ask, does this property or can this property pay for itself? So we are going to look at, in this particular loan type, projected rent compared to the actual mortgage payment. If the projected rental income will cover the mortgage payment, that's generally, and this is where the debt service coverage ratio comes in. We're looking for a ratio of 1 or better, then the loan will qualify. Personal income really doesn't enter the conversation at all. And I'm actually going to do a quick poll. I did this last week and got some good feedback on the poll. And I'm actually going to give you, remember back in college or high school where you got a cheat sheet and you kind of work off of it and answer. So I'm going to ask everybody, just to make sure we're all awake, to open up the calculator app on your computer or phone, whichever is easiest for you. And I'm going to show you the formula, just give you a little cheat sheet and help you to understand how we as lenders calculate the ratio. Okay, so the property is going to have $2,000 in projected rental income. Again, $2,000 in projected rental income. And let's say for simplicity, the mortgage payment is going to be $1,600 a month. Again, $2,000 in projected rent, the mortgage payment is going to be $1,600 a month. What is the debt service coverage ratio? All right, so in your calculator, I want everyone to put in 2,000, which again is the projected rent. I want you to hit your divide signal, and then the mortgage payment of $1,600 per month, and hit enter. And everyone should have gotten 1.25 as the ratio. 1.25 is a very, very strong ratio, and we do that based on kind of a rolling scale. But generally, lenders want to see above 1. Okay, that's generally the line. If it's below that, the client more than likely isn't going to be a candidate for a DSCR loan. In this particular case, if we have a home and we've got tools, AirDNA is one, a host of tools that we can actually leverage to confirm what that projected rental income, and we can do that ahead of actually going to contract just to kind of run the scenario and see if it works. But we can pretty simply do that math. We know what the projected mortgage payment is going to be. And so we can actually pretty early up front determine if it's a good candidate or not. All right, so very simple ratio. We run these scenarios. We're happy to do that for your clients. But ultimately, the takeaway is that this product is exactly it's the exact buyer that this particular product was built for. If you've got a client, maybe they own a rental already, they're looking to add a second. This can also work for first-time investors as well if they've got down payment requirement that's needed. But always worth the call to us if we can see if they can qualify if debt to income ratio is too high. I do want to give a quick gotcha on this particular loan product because I've had a couple of agents refer this particular product. The notion being, if you don't have the level of income you need, we might be able to get you qualified using this ratio. A couple of clients with credit in the 500s. They thought that it was just specific to the income piece being kind of eliminated, but it is not that simple. This is still contingent on credit. And the higher your credit score, the less down payment requirement, similar to other loan programs. Down payment it's normally going to run between 20 and 25%. That's a bigger distinction, if you will, but that's also pretty consistent with what's required if you're looking to step into the investing space. And then rates are going to run a little bit higher than conventional as well. But ultimately, the property has to make sense as a rental. All right. So any questions really quickly before I move on to the second product? Taxes and insurance would come into play. So it's the total mortgage payment, not just P&I. Good question, Kevin. All right, I'm going to go quickly because we've still got one more speaker today. So the next product is non-occupying co-signers or co-borrowers. This is a product that is less about investors and more about family, helping family. A non-occupying co-signer, again, long explanation in terms of the product. It's also sometimes called a non-occupant co-borrower, is essentially a scenario where someone goes on the loan to help a buyer qualify, but they don't actually live in the home. So think about a parent helping a kid buy their first home. I've actually recently had a scenario where a kid was going to help their parent who didn't have a ton of income qualify for a home. So it can actually go both ways depending on the scenario. But ultimately, the buyer's income alone doesn't help them to quite get where they need to be able to qualify for the loan. So the cosigner's income and their credit is going to get factored into qualifying. So essentially, that means all of the income combined and the associated liabilities still have to make sense. So I'll say that differently. If the cosigner has really good income, but they've got 3 cars and a house and a rental property, then it's probably not going to be a great scenario in terms of getting approved. But there are scenarios that might actually work. And we can actually do this on FHA, which is a government loan program, as well as conventional loan programs as well. The debt to income treatment is a little bit different depending on the specific program. So I am going to go ahead and close it there because again, we've just got a few minutes left, but that's a 2-for-1 DSCR for investor clients, perhaps messy DTI, and then non-occupant co-signers or borrowers for a buyer who's got the desire to own a home, but they don't quite have the numbers on their own. All right, and with that, I'm going to turn it over to Dixie.
Good morning, everybody. Thank you, Corey. So I'm going to talk about something today that's very underutilized in our market. And if you can nail this in, this will make you stand heads above other agents. Okay. So what we're going to talk about is down payment assistance. Okay. So there's lots of different types of down payment assistance. We'll just touch on a few today. So, um, a lot of agents don't realize that down payment assistant programs can actually be used for folks who are not just first-time home buyers. Repeat buyers can certainly use these products. A lot of these down payment assistant programs are more based on income than they are how many times you've owned a property. So there are purchase price limits as well to some of these programs, and the programs change regularly. So you'd want to check in with your lender to have them connect with you to make sure that certain programs are still available. And one tool that we have that we use all the time as a lender is Virginia Housing. So Virginia Housing offers a lot of really great down payment assistant programs. They have grants. They have second mortgage options for qualifying borrowers. These can be combined with other traditional type of loans like a conventional loan, an FHA loan, a VA loan, and a USDA loan. So these Virginia housing loans can piggyback onto other loans to help with things like closing costs and down payment. This can serve a wide variety of folks that you encounter. A lot of these limits are actually higher income limits than you would anticipate. So that's why it's super important to have a great relationship with a local lender. Some big entities and banks don't have access to Virginia housing. A lot of really great products. I've helped a family recently with a interest rate reduction loan. So you heard that right. They have a tool that you can actually reduce interest rate pricing by 2% for certain qualifying borrowers. And if you're in the know and know these products exist, you can make sure to help your folks utilize them. So the next product is very local, actually. It's TAP. And a lot of people on this call probably have heard of TAP, Total Action for Progress. And they're a local nonprofit that are located right here in our Roanoke area. They offer down payment assistant products specifically for folks in our market. So this product is designed to help first-time home buyers or just home buyers in general who have income that fall within their limits. So I will have Jonathan drop the link in the description box below for tapintohope.org. That is their website. And I would encourage everyone highly, every agent, to familiarize yourself with TAP. It is a local tool that you have and that we have as local lenders that can really help folks get into home. And a lot of times, your competition doesn't even know that that exists. So that will certainly give you an edge as well. So why does this matter? There's a lot of buyers in our market who've lost out in places and homes in the last 12 months. They had great income, they had great credit, they just didn't have quite enough money to save for down payment. So the down payment assistance conversation is a very important conversation to have, and it can mean them getting into a home or not getting into a home. So our recommendation is to strongly advise them about these products and knowing a little bit more yourself about these products so that you can bring knowledge to your buyers every time you have a conversation with them and not wait for them to necessarily bring it up to you because a lot of folks don't know that this exists. But if you have the knowledge and you bring it to them, then that will set you apart from your competition definitively every time. So that's it for my part, and I will hand it back to Jonathan and he'll give us a closeout.
Yeah, awesome. And I think it's a good segue because what Dixie just said to wrap up that particular program she was talking about, and the link is there if you want to see it. But what she just said, this gives you an edge over your competition. Here's what I want to tell you. The loan programs we've talked about today, the bank statement loan, the DSCR, the bridge loan items, this down payment assistance, all of it. If you could take any one of those or take all of those, I'm telling you with confidence, about 95% of realtors don't know those things are out there, and deals are getting, they're not getting closed. People are not buying homes because they don't know there's options that are there. You could take any one of those or all of them and market it and prospect it and build a business off of it. There's just a lot of deals and money being left on the table because people don't know there's other options. Okay. Now, to solve all of that, you can just refer all of your leads to us, and we can definitely tell you as we go through pre-approving somebody. We start with conventional. We might move to FHA. We might move to USDA. We might see if VA is an option. And if none of those are options, we start looking at all of these other options before anything ever gets completely turned down. Okay. But these loan programs are amazing. Most of my competition don't work on them, and most of yours don't either. So utilize them. One last tool I want to give you, and I'm going to drop this in chat too. So you've got you should have three different links in chat. One is on Calque, one is on TAP, Down Payment Assistance Program, and then the one I just dropped in is something called IHMC Go. Now, IHMC stands for Integrity Home Mortgage Company, but this website is built for realtors that you can go to and get quick little things that you need to get, little nuggets. Like if you need to remember what seller concessions can be on a conventional loan with 5% down, you're going to find it here. There's all sorts of little things. I would just bookmark this page because it gives you things you might need to have handy as you do business. Okay. So look at that. And then last thing I want to mention to you before we wrap this up are two upcoming things that I think would be very important. On August 12th, back at Roanoke Valley Association of Realtors in their conference room, we'll be doing our quarterly workshop in front of everybody, and we have seating for 50. We'll have breakfast items there as well too, but this is going to be different than what we've done in the past. We're going to have a panel of 3 to 4 top performing realtors in Roanoke that will do Q&A, but they're going to be sharing how they kind of shifted between mediocre agent or an average agent to being a top performer, what their mindset's like, what their work-life balance looks like. So all of this is important to me as I'm picking top performing realtors. I don't want to just have someone that's working 90 hours a week, spending 100,000 in marketing doing real estate. To me, that's not a top performer. Top performer is doing really, really good in your business, but you're still a great dad or you're a great mom and you've got your priorities right. That to me is a top performer. So we're going to have some top performers in a panel that are going to be there to share what their journey has looked like and how they've gone from where they started to where they are now. Okay, so would love to have you there. If you'd like to come to the August 12th event, it's at RVAR 9:30 to 11. You can drop in chat that you'd like to be there, and Ellison will make sure that we save a seat for you. And then next week, for the next 3 Wednesdays, we're going to be doing a little series, not anything like we've done in the past either. Um, we're going to talk about time and time management, but with a completely different flair. And if someone were to ask me, who do I think the most productive person is in the history of the world? My answer would clearly be Jesus Christ. We're going to talk, how did Jesus manage his time and how is it relevant to the life of a salesperson? So I would love for you to be here. This is a study I've been going through myself, and it's called Redeeming Your Time. And we're going to do that the next 3 Wednesdays. So we all struggle with time, all of us. I've never met a salesperson yet that doesn't seem to struggle with some time, one way or the other, how to balance it all. So this is quite helpful. All right. But I promise you it will be a great study. We'd love to have you back here the next 3 weeks. And hope everyone has an amazing Wednesday. Thank you guys for being here.